Financial disclaimer. The information provided in this stream is for educational and informational purposes only and should not be considered as professional financial or investment advice. We are not licensed financial advisors, and the content presented here is based on our personal opinions and experiences. Investing in stocks and other financial instruments involves risk, including the potential loss of capital. Any investment decisions you make are solely your own responsibility, and you should conduct your own research and consult with a qualified financial professional before making any investment choices. The content we share on this stream may not be accurate, complete, or up to date. Market conditions and financial regulations can change rapidly, and we cannot guarantee the accuracy or reliability of the information presented. We do not endorse or promote any specific stocks, companies, or investment strategies. Any actions you take based on the content of this stream are at your own risk, and we will not be held liable for any losses or damages that may occur as a result. Always remember that past performance is not indicative of future results, and no investment is guaranteed to be profitable. Make informed decisions and consider your risk tolerance before investing any funds. By accessing and using this stream, you acknowledge and agree that we are not responsible for any investment decisions you make as a result of the content presented. You are encouraged to seek advice from qualified financial professionals for personalized guidance. Please invest responsibly and only with money you can afford to lose.
Hey man, just found the next guaranteed multi-bagger.
Hey man, you found another one? What is it this time?
Come check this out.
Hey, what's up, everybody? Cheers. Happy Tuesday. Just got everything updated. I haven't really went through everything, so I gotta just kind of figure out where we're at today. I really actually didn't even get much of a chance to look at the market today. I was just busy. So just scrolling through. It looks like not really too much happened today. Asia's down. I'm sure that's probably still China's been getting smacked, so it just affects everything, I'm sure, in Asia. And I'm assuming this is just an ETF. Once again, I pulled off into the wrong spot there. But yeah, this is just Asia shares, the 50 ETF. But doesn't look like anything's really going on. Not too much. Not really like up or down. No like crazy moves if you look at like a longer chart. Although it's also not totally at its lows, so. But other than that, I don't know if there's too much going on here. Steel's up. I didn't hear much news on steel. I mean, that's a new core, so that's just a way to watch it, kind of. Oil and gas down a little bit. AMD's down a little bit. I'm curious to see where AMD would go against NVIDIA. I know NVIDIA tends to have like the higher end graphics cards or GPUs. So I know they have a little bit of a head in terms of like the AI race, but I'm surprised AMD's not really pushing for that. Because I know Intel's getting back in the game now too, so there'll be 3 competitors. I know that that's really more in terms of like gaming computers, but all that is going to lead to AI research. So, I mean, all of them are going to technically benefit from it. So, I just wonder where it's going from there. But yeah, it doesn't look like too much is going on. I was looking to see, you know, like on the high and lows and stuff, if anything was really standing out. And I mean, it's not that it doesn't look good. I mean, it definitely obviously still bullish right now. Tomorrow the Fed will talk about their stance on the rates going forward. So we'll see where that goes. But so tomorrow could be a bullish day based on some of that news. If any of you guys care about that short of a term thing. But it'll start to change the perception of the market and give us an idea. You know, we'll see. I'm assuming it's probably already priced in, but you never know. But what we could do is start going through the daily movers, because this is from Monday, but I did update the insiders, so that's from today. So we'll see if anything's moving around. Selena is up. has a lot of retained earnings for not really anything else going on. It's gold in heaven. What did this pop and drop again? Isn't this like yeah, barely. Man, some of these stocks, these are, you want to find risky. There you go. Hop into that guy. Lucid's up. One of my friends was telling me to look at Vivos. I know it's been bouncing up, and I typically don't look at pharmaceutical type, biotech type companies, but I have looked at Vivos in the past. I can't remember exactly what caught my eye on them, but they have popped in based on my screener. Oh, this is the other biotech. I just saw the short interest before I dove in there. Quanta saying, as always, that's another one that's just bouncing around. By the way, thank you for everybody who's been subscribing. Our numbers are finally getting up there, so we're happy if anyone's able to tune in. We appreciate it. We appreciate the conversation that you guys bring. I think that's the best part about all the sites that we use, whether it be, my main one I would say is Seeking Alpha, but Twitter or X, they're both great. Even Wall Street Bets, just to see kind of, I know on there it's like a lot of people are just messing around, but you do occasionally find like some decent, due diligence. And so anybody who's in part of the conversation, we appreciate it. We obviously are interested. We like to hear what other people have to think. We know that we're sometimes idiots, and you could just quickly point that out to us. So even if you're doing that, we appreciate it. Nothing yet. It's been so far this year. I haven't on the daily mover. Sometimes it used to be. I know last year, almost every time I checked, there'd be so many companies. Sometimes it'd be like 15 or 20. And I'm like, oh my gosh, I can't even keep up with this. But I feel like lately things have kind of like mellowed down. You're not seeing quite the big moves as you were. You do see stuff trend up and down, like Moln, for instance. But these are ones that like, there's a pretty wild story, and it's really debatable what the value is. So I can see why, it's all narrative driven, and it's probably a lot of people just trading it. So stuff really jumps up and down. The CEO of Moln is like death threatened by a bunch of people, and then other people love the guy. So we'll see where that goes. They did start selling vehicles last time I checked, which is, you got to start somewhere. Zero Fox, that's a cool company name. NGO. Hey Max. Hi, how would you recommend to learn this style of investing? Well, there's a few different ways. Obviously, you need to educate yourself. The more that you can learn about finance, the more that it'll benefit you. I wouldn't say there's any one way to go about it. The more you learn, the better off you are. You'll see certain people, they'll kind of pick a strategy and they'll just kind of really stick to just the bare bones of that strategy, which I'm not saying that's not a great way to do it. The reason why I bring up my point is I like to look at kind of all the different strategies and kind of let that meld and kind of pick and choose which parts I like to use and don't like to use, and then kind of formulate my own strategy based off that. So, obviously, this is like deep value investing. That's probably what you could argue it is. I would say it's value investing as well, and a little bit of swing trading, and that's more just because of the style of these companies, because they're so volatile. Stuff gets cheap, and then it might only take a month or two once a news story or once something's turned around in the business for it to really take off. And, I'm not really trying to necessarily time bottoms, but typically when I'm researching stuff, I'm finding stuff close to lows, or they're just cheap on book value or something like that. So when stuff gets that cheap, it tends to swing up from there well without, you getting crushed on the downside. Because, if you've ever, but, there's all kinds of books, it's whatever style you learn best from. I do well from kind of everything. I listen to other people. I listen to a lot of podcasts. I've read a ton of books. And if you want, I could give you some suggestions. It depends on where you are in your investing style. Everybody's going to have read probably some of the more basic things, or at least have an idea of some of these things. But if you're someone who's really brand new to investing, there's a bunch of places you could start just to get you an idea of what kind of style you might be interested in. Obviously, watching the stream, you can see what our style is and see if that's something that would interest you. I'll warn you right up front that we take on a lot of risk. In terms of like, I know risk is based on, like, you could argue what risk means, but just on like a beta, like we pick very volatile stocks, which is how you get outsized returns, in my opinion. So, the risk for me is like, if you're looking a lot of people like to learn a deep value style. Like, I watched the Roaring Kitty videos, the early ones. Yeah, I mean, that was the same way. That's how we started. I would say the original probably like 10 or 12 videos from RK were this style, which is where the idea came from. And I learned a lot from RK. I always give RK the props he deserves. He's definitely, kind of launched me forward in this direction. And being able to watch someone successfully find companies, it just gives you kind of, to see it be done successful. It shows that it will work. It does take work. It does take time. That's another thing, just kind of balancing your time out, making sure that you're able to put the time in. The spreadsheets are super helpful. It helps you stay organized, but it's not like you have to have spreadsheets. This is just one way. You could use a few of the major sites that are out there, and just track a few companies at a time, and you could make it work that way. To be honest, I in my database now, I'm at 1150 for companies, although some of these I have to remove because they've either went bankrupt or merged or been acquired, whatever. So, like, I one day I'll go through and kind of edit those out. I tend to do that every like 3 months when I update the overall spreadsheet, because I pull a lot of stuff in. But yeah, I mean, deep value, there's some great books. Obviously, Tobias Carlyle's book is called Deep Value. There's one you could start with. But I would understand value investing in general, knowing what your margin of safety is. Benjamin Graham's obviously books. You can follow Warren Buffett's type stuff. Everyone, it's funny nowadays because people, there's always the camp that loves Buffett, and then there's a camp that kind of gives him shit lately because, it's not like he's getting these returns like he was when he was younger. But when he was younger, he was doing this. He was going through and finding just very specific companies and kind of finding things that most people weren't looking at. And then he was just able to kind of pick and choose, and he used value to kind of screen for these things. Listening to investors who are better than you, I'd say that's another thing that really helps. So, for instance, I'll kind of get my own idea on a stock. I like to kind of like just look at the fundamentals, just get a basic idea of what's going on. And then when I'm looking on Seeking Alpha, there'll be investors who have been investing for years, decades. And I'll listen to the way they talk about a stock or a business and the amount of understanding that they have, because that's what's going to make you like get to that level. You have to be able to understand a business that well. So when something's changing, you know what to look for. That's another thing. Like, there's so many cyclical companies that turn into value that you have to know not only what makes it cheap and where in the cycle it's cheap, but what's going to cause that to turn around. That's always the big thing. I've learned too, whether you're looking at a company who has like assets that aren't being appreciated, or the chance of them being picked up by another company is high, knowing when those are going to occur and kind of what setups are more likely for those to occur. That's one way that you can kind of hedge your bets a little bit in terms of what you're picking. And then, if you read stuff on like Burry always talks about, it's just as important to know the business and all that as it is to do portfolio management. I tend to take pretty large positions in terms of concentration of my portfolio, so I can hold just a few stocks. It doesn't bother me at all. But I know those businesses really well, and I'm able to kind of get in and out of them. Luckily, I'm obviously a small retail investor, so it's not like I get stuck in something. Yeah, I mean, I do put stop losses in place to kind of hedge my risk. That's how I deal with my risk in the companies that I look at. But I would argue that you could also obviously invest in any stock that you kind of looks like value. And as long as you're just putting small percentages in these things, if you tend to pick these and hold them long enough, a lot of them bounce back. 20 stocks in hindsight for the performance. 1820 were insane multipliers. 2 were break even. Performance really still achievable. Yeah, I mean, obviously it was a big part of that was the Corona crash. So, but that's something that like, yeah, no, I see what you're saying. But yeah, it's not as easy today as obviously it is as at the bottom of like, you know, like the Corona drop, like when everything's sold off and everything's super cheap. But the more important thing that's there is if you're looking at distressed companies and you're looking at ones that could go bankrupt and you kind of hedge your bets across, you know, I think RK had like 150 at some point. If you do that at the very bottom, your chance of even a few of those surviving and turning into 10, 20 baggers, it can happen. You know, there's still going to be plays that are more important than that, but it is all those things. And not to say that if there wasn't a crash, like let's say over the next year we go into a terrible recession and everything sells off, when it starts to get to where you're going to watch, like, you know, I'd be paying attention to all kinds of different technical indicators probably to try and find a bottom or just start to see things turning around. And then you'll start to hop into things. And yeah, stuff can go down, but if it's already sold off, let's say 50%, you know, I mean, stuff only usually goes down so far. If it's, this is why it's important. RK always mentioned to watch the bonds. Bond traders, you can really tell. That's a great way if they do have bonds that are rated to know where they're priced at, to kind of see how distressed is. Because if bondholders are bailing, like, you know, obviously equity investors are going to get screwed. So it's just different ways of understanding what the risk is and knowing how to manage it. I would say that's the real trick to deep value, because most people look at like ETFs and they're like, oh, value hasn't performed. Just look at this ETF. This is a value ETF. It's a value ETF that covers like 2,000 stocks that are considered value. So it doesn't mean anything. Like I don't look at 2,000 value stocks and be like, yeah, these are all great choices because on some value I find them cheap. No, there's very few of those that are going to lead to actually good returns. And it's your job to kind of sift through it all and find the ones that are going to work. So that's part of the screening process here. That's why every day I'm going through these movers. I'm seeing what's up, what's down. I'm seeing what insiders are buying. I'm following bigger funds. I'm following, you know, value funds usually. I'm following different analysts because, you know, usually they're looking in the deep value style. Yeah, I mean, those are the two ways that the dashboard works. And, you know, mine's a pretty close copy. It's almost a 1-to-1 to how RK built his. I've done some quality improvements for myself that made sense to me. Once you learn, I use Excel, RK use Google Sheets. It doesn't matter which one you use. And I'm sure there's other third-party ones you could use too. But once you kind of get an idea of what you're looking for, you'll start to like cut things out because you're like, nah, I don't really need this. Or I wish I had that. And then you start to build it out. And kind of every once in a while, I make like a list. And I just kind of go through and find, you know, like, one of these days I want it to do this. And I'll write that down. So the next time I got some time, you know, I got like a few hours to really sit here and play around with it because, you know, I'm decent with it. Obviously, regular Excel, I would say I'm somewhat advanced now because I've done all this. But in terms of like VBA and macros, which is like the coding style for this, I'm not great at that. I know the very basics of it, and I've definitely learned the basics of coding. But, you know, I can go on like Stack Overflow and someone can help me with like a question I have. And, you know, thank you to everybody on Stack Overflow who helps out. You guys are amazing. But I'll be able to kind of start my approach into something, because something that would take me an hour of playing around to get it to code, someone in like 5 minutes will be like, just do this. And then I'm like, oh, thank you. You answered my question, because I would have never figured that out like you just said it. So, yeah, it's a mix of everything. But yeah, I would say, you know, it just depends. And, you know, as you have questions, like that's one thing you can do. How many hours do you think is a minimum to research new stocks in a week? Honestly, it just depends. It depends on your style. And for instance, if let's say in a given week, if your life's super busy and maybe you got like 3 or 4 hours to look at stuff, I would probably start to look at Open Insider, that kind of thing, and maybe check Seeking Alpha. If you just started with just those and you're just looking at kind of some of the major stocks that people are holding, if you look at a stock, even if it's like a micro cap that most people aren't looking at, but you can find 2 or 3 funds that have it as like one of their top 5 positions and they've bought somewhat recently, then that should throw a bunch of red flags. Like, that's something to look into. So the trick is, if you don't have a ton of time, just make sure you're using that time valuably. So when if you only can look at, let's say, a few stocks in the whole week, then hone in on the ones that are most likely, like, other people are looking at. And then as you start to build up your funds and you can put more time into it, it makes more sense to put your time into it. You can expand from there. But I mean, it kind of, you have to enjoy it. You have to like this process. I think it was funny to me because after watching the RK videos, the one thing that always blew my mind is that most people, I mean, I get it that people got stuck on the GameStop idea and wanted to just stick with GameStop, and that's fine. But if you didn't appreciate those first, like you said, like those first 10 or so videos, and just like, just his whole process, I was just like, this is crazy that someone, he just sits here and does this and is able to find stuff. And, as a small, I guess before I had seen something like that, I didn't know it was really possible for just a retail investor to be able to find this, which is why I found the stream so helpful. It just kind of presented a guide on like, hey, if you want to do this, this is one way. So, I just took that and ran with it, and I was like, all right, like I can figure this out. I think anything you put enough time into, you'll get good at. I mean, that's always been my philosophy in anything I've ever done in my life. And, when you start to spend, years on things, you get very good at it. Like, name a job that most people do that they've done for years that they're not, pretty good at. Most people within a few years of doing any kind of job, you get good at. Investing, honestly, as long as you're decent with your portfolio management, you can make mistakes. You're going to make mistakes. And you should learn from them. And then, you'll just kind of build out something that works for you. But that's part of the reason we wanted to do this stream. Not only do I enjoy the process, but I like educating others too. I like other people, like I said, critiquing what I'm saying. Yeah, like, you have to have like a passion for this. Like, and that speaks to your personality. I have a few friends. Thank you. I appreciate that. I have a few friends, for instance, that are, I wouldn't say as patient as I am. And this is a much more patient style of investing. You do have to move quick at some times, but most of the time you're just kind of following the information. You're just kind of watching as stuff's happening. And, some of my friends, they definitely aren't like that. They need quicker, like, results. And like, those are guys who are probably going to be better at like doing trading or something like that, because they kind of need that quicker return. It needs to, and maybe that interests them enough that they can get good at trading. Trading to me is like, I feel like my heart's going to pound out of my chest. Like, I've only done like a few like trades per se, or I watch streams of some traders, and I just don't have the stomach, I think, for that. Like, this is a style of investing that I can do, that I enjoy, and that I can go to sleep at night and I'm not up thinking about like, oh my God, should I have sold that or should I have bought that? Is once in a while maybe, but in general, I'm sleeping fine, and I think that's a big part of it. Is make sure you can go to bed at night and not be just constantly thinking about like, when should I sell this, and it shouldn't be that stressful. But yeah, so just you keep taking stuff, I have so many things still listed, so many books and stuff that I want to get through, or just stuff to read, whatever it is. It doesn't have to be a book, just stuff online or podcasts that I'm listening to. One of the first ones I'll throw out, and obviously, as a disclaimer, no one's telling me to tell you guys like who I use, but here I can just pull up, like, I use Spotify for my podcast, but I don't care who you get it through, and I'm not in any way saying that Spotify is better than the other ones. It's just that's what I started to use. But I started listening to Invested with Phil Town and Daniel Town. That's great, especially for really new investors. They talk value, and it's very a Buffett approach, but I appreciate what they do. What else is there? Here we go. Oh, I can figure this out here. The Choirs podcast, that's Tobias Carlisle's. He wrote Deep Value. So The Business Brew is another one. Focus Compounding. Those are some of the ones I found, that I like. I like what they have to say. And I don't always agree with what they're saying, but these are very knowledgeable people who have their own styles. And like I said, I like to kind of hear everybody's style. I like to take bits and pieces, and kind of formulate my own thing. You can go on YouTube and find all kinds of great stuff on there. I shoot for 50% returns. That's my goal every year. And actually right now, knock on wood, I'm like at exactly 50% for the past 3 years. So it is achievable. And like I said, the way that I find that I can do it, and like I said, but it's nice to hear Tobias's like thoughts, like Toby, like the way he goes over things and I get it. He's looking at a lot of big, like almost more macro, or I don't think he is, but that's on the podcast what he talks about, because I know they can't necessarily talk about the stocks and the funds that they use. But like, I'm not a fund, so I don't have to worry about that kind of stuff. Well, and you say, wow, you're great, and who knows? I could be lucky on some of my picks. Like I said, I rely heavily on other investors' thought processes, and that's kind of helped to shape me. Obviously, I've had a few stocks that, I pick, and I'm just like, I don't know, this one looks good to me, because that's the other thing, too. When you look at 1,000 stocks, probably like 900 of those stocks, like there's just not much. I just don't see much that's going to catch my eye. And who knows, those ones could jump 10 times, but it didn't catch my eye. But when I start narrowing down to, like, let's say there's 100 stocks that like I put on deck, and those are interesting. And then of those, maybe 10 of those ones are like really, like I actually really think something's there, and I'm just kind of waiting for it to get cheap enough or whatever it is. And those ones are kind of the ones I tend to get in and out of. Those are the ones that I'm really sure that my thesis is right, regardless of what other people think. And that's a big thing. You have to be contrarian. You can't just always go with the crowd. If you do, you'll end up selling out because you'll get paranoid, and other people are going to convince you like, oh, you're wrong. It's no different than what RK did with GameStop. I mean, you go in through the comments. A lot of times when I'm interested in a stock, and there's someone else like posting about it, and everyone's giving that person shit about saying like, oh, I can't believe you like this stock, like this company's going bankrupt. Those ones interest me, because if everyone's against it but that person's right, that's the one that's going to bounce 50%, 100%, 2, 3, 4 baggers. You know what I mean? I don't tend to play a lot with options, which options are obviously a way to like, increase your returns. But with options, obviously, then you have to time it. So it's not only do you have to be right in whichever direction you're saying, but also you have to time. So there has to be like a really obvious catalyst, in my opinion, for options to work out. And they also have to be cheap. If you're looking for long-term leaps like RK did with GameStop, like you have to catch it at the very bottom. There has to be low volume, because even if there's a ton of volume, it still doesn't mean the option's cheap. You can end up paying a ton just for the price of the volume, or the volatility of it. So to, like I said, to predict my downside risk, I put stop losses in place. So if I'm taking, like I said, large positions, I only need a few of them to work out, and I can be wrong on, let's say throughout the year I pick 10 different stocks that I go heavily into. If I'm right on 4 of those and I'm wrong on 6, I crush it, because I'm putting like 10 to 15% stop losses, usually at 10%. And then the other ones are, I'm starting to sell out around 50%, but it sometimes depends on the story. And this is another thing, obviously, that I'm working on, is I get to 50% and I'll start to take some winnings there. But from there on, I kind of let things drag out. And usually I can kind of bump it up to, it was a 70% return or something like that. So if I have 4 or 5, 10% losses, I mean, yeah, most people would be like, oh my God, that's intense. I don't know how you do that. But for me, I don't care if the other 4 picks I had all made over 50%, it well outweighs itself. And then you're not also having to deal with like the tax issues. It depends on if you have a brokerage account, or obviously if you're doing it in like a tax-free, like if you did this in your Roth. So it'd be a risky portfolio to do in your Roth. So I don't recommend that. But, no matter what, the style is risky. But I find that's what you have to do. You have to take the risk on. If you want outsized returns, if you don't want to take the risk on, then just index, and do what everybody else does, because that's how you can get the regular, let's say 8, 9, 10% returns that are typical of like an S&P. How much focus the short interest, and how much weight would you say is technical in your investing style? Like 20% technical or more? It's hard to put a percentage on it because it depends. I would say I wouldn't weigh technicals that heavy until I know the whole story. Like I have to pretty much be really confident in what the business is doing, what the narrative is, or where it is, if it's a cycle type thing, like where the commodity is or where the business is in its cycle. Once I understand that, that's when technicals kind of come into play, because then I'm going to start to kind of trunch into something once it gets to a point. And obviously that's still within my margin of safety. So I would say the value of it is really high. Narrative matters. I'll pick a stock that's pretty levered. Usually the stocks if I'm going to go into are usually levered, because stocks that aren't levered are usually fairly priced. I mean, it's a lot easier to value something if it's not highly levered. And then usually it's too expensive for me because I'm looking for a large margin of safety. Probably in comparison to most, I'd say most of my like values, when you look at them, most people would think they're pretty conservative, but that's the whole point, is I want them conservative. I don't want to just buy into anything. And I do try to stick below those value levels if I'm going to buy into something. And short interest is like a bonus. I wouldn't ever say I'm going to buy a company just on short interest. But if I start to get interested in something and short interest is high or creeping up, that would possibly be interesting to me, because obviously you could get some kind of squeeze. Especially those are usually with like a narrative change, like you're looking at a company that's trying to turn around, or maybe there's like litigation or some kind of like political thing against them. Those are the ones that, but it's tough. And I don't think you're going to see short interest ever get quite as high as you did with like GameStop, because I mean, you watch billion-dollar hedge funds fall apart with GameStop. I don't think anybody's going to take that risk anymore with the way meme stocks work and stuff. You could go on tomorrow and just post, hey, look, this stock has 70% short interest, and if we buy it right now, they're screwed. And regardless of whether there's any merit to that, if enough people buy, yes, those shorts are screwed. So I don't think the shorts will ever take on that much risk. Last time I had pulled it up on here, let me just go to it real quick. I had the short interest up on here, and yeah, FSKR was the one that's at 47%. So I mean, don't get me wrong, it's high, but they may be truly at risk of bankruptcy. So just because you see short interest, it's just something to take into consideration with what's going on. Like I said, it doesn't necessarily mean that anything's good, but usually if it's that short, like there's probably risk of dilution, there probably risk of maybe defaulting on some kind of debt or something like that. So all that is large risks that you have to be able to be willing to take on, and most people I don't think are going to be willing to take that on. But yeah, that's my long way of saying that's kind of like the way like I start to approach things. Yeah, I mean with liabilities and leverage, yeah, I mean your liabilities, it's all on what will trigger something to default. I mean, that's really your true debt risk. I mean, it's not, equity is in no way necessarily like it is under like a liability or on that side of the balance sheet, but it's not truly debt. Like you can't, like, you can screw your shareholders over and drive your share price into the ground, which could be bad for the company. It could delist you and all that, which could be concerning in its own way. But the only way you're really going to actually go into bankruptcy is by defaulting on debt. So there's a few different things about debt. It's a really dense book, but Security Analysis, I know it's old, and I'm sure there's other books you could read on, but that was a great one just because it introduces you to the basic of bonds, of debt, what's secured, what's unsecured, how terms work, revolver loans, all those different kinds of debt. So it gives you like an idea of what these companies are using these different styles of debt for, knowing maturity rates, knowing interest rates, knowing how much free cash flow the firm has to be able to pay those rates. Also knowing like the balance, like, it's some companies that it benefits them depending on what the interest rate is on the debt. If they're making, like, let's say you're making 15% on your free cash flow, and that's like a strict number versus your debt, and you're only paying 8% interest on your debt, well, it would start to benefit if you take on so much debt if you're going to guarantee that 15% cash return, because you're gaining 7% over what it is. But if it starts to get too high and that interest payment slowly starts creeping up and it eats into your free cash flow, and now your free cash flow goes from 15 to 14 to 13, and now your debt interest is becoming 10, 11, 12% of the money that you make, you can kind of run where you're running almost even, and then there's nothing left for shareholders. So the big thing is seeing what's left over for equity, because as a stockholder, that's what you're looking for, is you got to see what's left over for you guys. So if they don't have any kind of like retained earnings or dividends that they're paying back, share buybacks, or they're not reinvesting in the business and causing positive growth in the future, more free cash flow, then that's where it starts to become with a concern. In terms of understanding covenants, when you pull up a company, I had Loom here. Loom has a ton of debt. So when you go into like the SEC, for instance, and you go to like a recent 10K or 10Q, you can go to the interactive data here. If it ever loads, there it goes. And so obviously here's the balance sheet, which, $311 million in cash, which is, very liquid. And then so current maturities of long-term debt are 155. So they have 310 in cash, 155 in current maturities, so they can cover that. So like that's good. Obviously, you have to take into account other things that they may have to pay, but you got to think accounts payable, accounts receivable, money's flowing in and out of this thing. So some of these things balance out. But as long as they're able to pay this, that's what's important. And then obviously you can look at how much is. What's their actual long-term debt here? Is it this 19? Is that their actual long-term debt? I mean, so they got 19 billion. Is that right? So $19 billion in debt, with $311 million in cash. Like, this starts to get real risky. Like that number should be like, what? So you start just looking at basic things like that. And then you can go to notes to financial statements here. You can see the long-term debt and credit facilities. So it'll start talking about what these are. It'll show you the maturities. So like you can see that like some of these are maturing in 2025. You can see what their interest rates are that they're paying on it. And you can start to cash, like you can see that, okay, the $75 million one, not a big deal. Term loan A that has $948 million, they don't have that much in cash right now. That's a big deal. They have to somehow either restructure that or they're going to have to dilute shareholders to raise more money through equity. So, and it did say, it says the interest rates too, but the interest rates don't matter once you obviously you get to maturity. So, by 2025, they have to figure this situation out. And as it gets closer to that and the company starts to run out of time, it starts to become concerning. And then if, these are term loans, so these are probably just with other big credit things, but, it tells you for the remaining 3 months, they got 40, 2024, they're safe because they got the 157, but 2025, they need $1.7 billion in cash to pay off that debt, or they need to push it back and restructure. And that's the issue with interest rates being higher right now, is all these companies that are questionable in terms of bankruptcy and their leverage. It becomes dangerous for these guys because if they have to restructure in this environment and then they have to raise their interest rates, then they're losing even more money. And it's kind of like this, like vicious cycle where they're just kind of getting dragged down and the debt starts to just kind of take all their money and they can't get out of this. So, and you can see too, it does say covenants. Certain of our debt instruments contain affirmative and negative covenants. So you can read through the actual 10K and the 10Q and it will tell you what those covenants are. And then obviously the other thing too is if any of these are, actual bonds that like people can buy, you can go to FINRA, and in FINRA you can actually see what people are, how these are trading, how often they're trading. I hate how FINRA redid their website. It sucks, the new version. FINRA, go back to the old version. It's so much easier to find stuff, but you can do it this way. So we can type in Loom here and apply a filter. and then you'll hit done. So none of them are actual bonds, so we can't use the bonds for this company. So this isn't they're not selling bonds. It's all just stuff through credit facilities and whatnot. Is how they're getting all their money back, or that's how they've taken on all their debt. And some companies in certain industries run really high levered, and that's just because it makes sense. Because for instance, if there's not like a ton of like utilities, for instance, have a ton, but that's because it's really capital expenditure heavy in order to, like, let's say you're putting up power lines and that, you know, you got to pay a lot of money to get all that first. So you take on this debt and like, but there's no competition because if you're like a utility, you kind of own like a region or something like that. So you don't have to worry about someone necessarily coming in and fighting you for it. So you can kind of take that risk on, and then, but and then it comes down to management. Like, is management doing a decent job with the leverage? Is that beneficial to the company, or is that actually worse? So those are all questions, like, as you start to get into this, you start asking yourself when you're looking at these things. Sorry, that's a lot. I don't know I hope you're able to follow along. But yeah, I mean, so yeah, and you can obviously, if their bonds and anything are rated, you can use those. The credit facilities are great. And you can look at what the risk rate is for those based on whatever the credit facility is. So, you know, if it's like double B versus, you know, like triple A, you know, what you should assign as your risk rate to those, that all matters. So I don't necessarily go through the entire trouble of doing like a discounted cash flow to really figure out like my risk-free rate of return and the risk premium. Those are ways of doing it. And I'm not to say that those aren't accurate ways, but kind of like our case said, the problem is you could go through there and you could try and really calculate a value for a company. You could really go through and look at all the assets and compare them to all these other companies and on average what they should be. And you could do all these calculations for, let's say, like if it's in a foreign country, you could figure out what their risk rate is and what the industry's risk rate is. And you could come up with these really precise numbers and spend hours working on this. But in the real realm, it's probably close, and you probably could have just done a few simple like equations and kind of got close to that number. You could look at a historical chart and probably get close to it. I'm not saying the charts are obviously, you know, just where something trades doesn't mean that's where it should trade. That doesn't mean what the value is, but it's just something to think about. So, you know, I'm reading some of Aswath Demorden stuff, and that's great too. If you really want to learn value, he's got his stuff on YouTube, or his books are fantastic. But they're pretty in depth. I mean, you got to really, like I said, it's got to be a passion of yours if you're going to try and read through and understand the value side of things. Which I get it. I can see why some people just don't want to take the time on to actually do it. But still not generating. So, you know, continuing screeners. So, you know, like for instance, this one's cheap on a book value basis, has a lot of cash that it's just sitting on, but it's not generating anything yet. So it's probably a younger company. Yeah, it IPO'd in 2021. Well, you can just do some simple math to kind of figure out when a company is going to go bankrupt. So, for instance, in 2025, that company needs to have $1.7 billion, or they, at a certain point, like, I know it said 2025, but let's say it's June 13th of 2025, that maturity is due. You have to pay those bondholders back. It is your obligation to pay those bonds back, or those notes, or those term loans, whatever they are. And when you can't go to a bank and be like, no, I don't have the money. If you go to them and they say, we don't have your money, they can immediately basically file a Chapter 11, and they're going to force you into bankruptcy. And when you get forced into bankruptcy, you're going to go to a court, and in court, they're going to start looking at your business, and they're going to say, they might pull in like a credit agency and see if there's, hey, is there anything we can do? Because obviously people want to get their money back, and you know, you might be able to restructure something into, they might be able to work on you and restructure and try and knock some of that cash off, because sometimes the bondholders will just take the loss because they'd rather at least get some of their money back than none of their money back. But they're going to look at all your assets, see what they can sell off, and whatever money's left over is what's going to get paid out to those bondholders, and the company will just get dissolved. It will just disappear. So when we're talking about what's the indication of going bankrupt, it's when is that money going to be due, and can you afford it? You can spin parts of the business off, you can sell assets, you can argue and try and you could try and restructure your debt. Like, you could go to a company and say, like, hey, we're changing this around. Look at how our numbers have improved over the past, 3 quarters or whatever like that. And maybe someone's willing to take on that risk and be like, yep, all right, we'll allow you to push your maturities out now to, let's say, 2027. But when you're that far in debt, I mean, those are risky ones that even for me, I see that much debt and I'm like, I don't know. I don't know how they're going to do that without. And the other thing they can do is they can raise money through more equity. But if you raise money through more equity, you're diluting shareholders even more. And if you dilute shareholders even more, each share is worth less because it's worth less of the company. And, it's not like it always works out perfectly like that, because not everyone, you can buy a share for whatever reason you want. You can go buy a share of, you see companies going to bankruptcy and they jump, they're like a 3-bagger from, where they're dead. And really that's just people investing. Like, you can buy whatever you want. You can say, oh, I think they're going to come out of bankruptcy. Well, even though there's nothing left and there's no reason. But the share prices, like there's like the old mantra, it's a voting machine, and in the long term or whatever it is, it's a popularity vote. And then in the long run, the fundamentals will basically shine through. And there's obviously truth to that. And it's just one of those things that, like, it starts to become a risk. So when you're a fund manager or you're an investor, let's say I have company A and company B. If company A makes $1 million in free cash flow and they have, let's say, $500,000 in debt. Well, if they're making $1 million in cash flow and they have only $500,000 in debt, it's not really concerning to me, because they can, if they had to, let's say they had to pay that debt off, they have cash to do it. Now, let's say company B makes $1 million, but it's $2 million in debt and keeps adding debt on. Well, now that business becomes risky. So it should be reflected in the stock price. That stock should trade cheaper, even though they both generate the same amount of free cash flow, just because there's an increased risk that cash flow in the future could stop. And the whole point is kind of predicting out into the future. That's why, growth investing can either be like the greatest or like the worst thing for some people, because if you're predicting a company is going to grow over the next 10 years and you're able to accurately predict that, you can buy a stock when on a value basis it might look very expensive, but if you're like, no, but in 10 years it's going to be here, it might be smart to invest at a high ratio. Most people use PE. I think PE is stupid. I find it kind of useless. But I know why people do use it, but I don't like to use PE. But sorry, I lost my train of thought. If you're a value investor, you're kind of doing the opposite of what a growth investor is doing. You're waiting for stuff to come on the backside where it's kind of sold off for some reason and it's below. Because if you're wrong on growth, that stock price is going to come back. Like, if you invested at Tesla at the very top because you thought it was going to keep growing, and you're buying shares for $2,000 or whatever they were for if they did the stock split, and then everything comes back down, you get killed on it. But if you were someone who bought way earlier on and said, I predict in 10 years that it's going to grow to this size, well, that growth investor is on top of things and was correct in saying that in 10 years it would get to here. And now they are selling. But it's funny how it works, because like you're seeing Tesla's earnings start to actually affect the company now. Well, Tesla now really does have numbers. You can really value Tesla now, where originally you didn't really have much numbers to go on. It was still just all like kind of theory, and they were just starting to sell models. But now you have a really full-fledged car company that's selling models, and we know how many cars they're supposed to sell, and we know what their predictions are. And when they miss or hit those things, I mean, you can see it directly in the share price. So I don't know. It's obviously complicated. There's a lot that goes into it, which is why even as a value investor, I have to appreciate the fact that I can try and value something, but there's so many other styles of investing out there that, some people invest just on narratives. Some people just invest because they want a dividend. Some people invest because they like the chart. Some people invest because their friend told them to. All those things are happening all at once, and all of those affect the stock price. And where as a value investor, I might be like, it shouldn't be worth this. If it is worth that at the time, that means in my valuation, I didn't take into account all those other styles, which I think is what most value investors miss, is that you have to take into those other accounts, other styles. It doesn't matter whether they're right or wrong. The price is what affects it, and that's why Buffett in the long run, like you see some of the more successful value investors say, like, you just look at the long run. Like all the other stuff, the narratives, growth investors, all that stuff, to people who are trading it, that stuff's all short term. But if you can find a business that's going to grow over the next 10 or 15 years and it's going to be way, way bigger, like if you were able to look at Amazon when it first started and you were able to be like, nah, you know what, I think in like a few years, they're going to keep adding on more and more and become like this big online monopoly. If you were able to predict that, then, obviously Amazon would have been a great buy. In a traditional value sense, you might not have been able to do that. But, I think value sometimes and growth go kind of hand in hand. I think sometimes the line gets blurred there in what's growth and what's value. But that's why it's important to understand the business. I find if you can understand the business, you can make a pretty simple business thesis. Like RK with GameStop, people said that he tried to cause a short squeeze. Like you watch Dumb Money and some of these other takes on it, and obviously they did zero research. It wasn't that. He had just looked historically at what free cash flow was during a console cycle. And yeah, he realized that the company was levered and they had been performing poorly, and they were, management in the past hadn't done well, but it was new management. And he just said, listen, there's a real obvious catalyst coming up where they're going to generate more free cash flow and earnings than what people will expect. And that's what he bet on. He just bet that because he understood that GameStop's not going to change their business. They're a retail store. He had talked about, obviously, them changing the style in terms of maybe they'd be more e-commerce or that they might start opening like game arenas where they would do tournaments and all that. And that's all other things that could happen, which, just is somewhat to add into your thesis. But it's more important that that he just saw that, when this occurs, there's going to be free cash flow. Michael Burry said the same thing. Like, Dumb Money didn't even touch on that. Dumb Money didn't touch that Michael Burry was one of the first ones besides RK to put out a huge report saying he was bullish on it. It was once his largest position. To say that, like, it was a bunch of no-name retail investors who were uneducated, knew nothing about what they were doing, and just bought the stock because they liked memes on Reddit, just goes to show how little that people actually understood what was going on. When Michael Burry is against you and you're a large hedge fund, you better double check your work. That's a guy who knows what he's talking about. And I'm not even saying that RK didn't know what he's obviously he proved he did. But when you had, he just was unproven. He was just small at the time and you hadn't heard the guy's name. But if RK came out today with a big fund, don't tell me people wouldn't listen to what he's saying because of his success. And the same thing with Michael Burry. You could talk whatever you want about him. You can say he's right or wrong for all kinds of different things. I mean, obviously he calls things kind of crazy at times, but he's quick. He moves in and out of things, and most people can't follow kind of his style because it's not like a simple cut and dry, like cut and paste kind of style. He looks at things, objectively from every stock that he looks at, and that's how he makes his decisions. Or when he's investing in overall stock ideas in the macro environment, he's looking at these things from all these different angles, and he's able to kind of hone in, which I think most people don't do. Most people are like, I look for A through D on all stocks, and if it hits these ones, I invest, and that's it, which is fine. But you're not going to see what like someone like Michael Burry, who's a little bit more calculated than that's gonna what he's gonna do, what he's gonna find. He's gonna see things that other investors aren't gonna see because he's not willing to just look at just a few things and then be like, nah, I can't really. He's gonna delve in and he's gonna make his own assumption on things and prove whether he's right or wrong. So do you use a debt ratio to screen high leverage companies? I like the site Ticker for fundamental screenings. It's good and cheap for retail investors. I think also you can't say this is value and this is growth. I mean, even some growth companies have great value. Yeah, no, and that's kind of what I was touching on. So yeah, I think it all adds in there. Hey, speaking of FSKR, I just noticed that's on the daily movers. It's cheap on a regular book value, but it's not generating much. Can pull that up. That'll be an interesting one just to pull in. But yeah, so Do I use debt? You know, I have over here. I have revenues to debt. I have the Z score. You know, Z score is probably something I'd pay more attention to, but it tends to be, for instance, like you can just see. Look at this. Look at FSKR. It's 884% from a 52-week high and 17% from a 52-week low. Obviously, there's something going on there that's extremely bearish. Like you can just tell just by looking at that real quick. I can also see that it has 73 in revenues, but its market cap's 445. So obviously it's not generating what it once was, or it's, you know, it's just high. I mean, you know, if you're only generating 73 million and your market cap's at 445, that's kind of throwing some red flags. Then I don't see any recent earnings or any cash flow. So those are all things where okay, that's probably why it's not performing well. On top of that, it has a ridiculous short interest, which at 445, it doesn't even sound like it's been shorted that much. I mean, now we are getting into the sub-dollar for shorts, which, you know, for me, if I was shorting something, I got down that low, that might be where I'd start looking for exits, because some of these things can pop back kind of quick. But, you know, it might depend on share count and the float volume, that kind of thing. So, I don't know. It's all just stuff to take into there. But... So, I mean, from Monday, there was a lot of stuff that had moved up. I'm curious to see what had moved around today. Some of the Chinese companies I see had bounced up, and now they're right back down. So, that's a tough market to invest in right now. So many people are so skeptical of, which I understand why. I mean, there is a lot of political risk there. You know, CareCloud, this is one that kind of interests me. You know, like if you look at revenues compared to market cap, it doesn't have much tangible book, so I have to figure out what that is. I've looked at CareCloud. I mean, CareCloud, it's all tech, so that's probably why. But it does have free cash flow, simple free cash flow on how it's spending it, and it was up 229%. Now it is a market cap of only 22 million, so it's very small. So it's the kind of thing, you know, it has had some insider buying. So that's like I'm saying, these are things I look at, and you know, these are more risky stocks, but this is kind of what you need to look through. You kind of have to sift through stuff that's looking ugly right now. I think Michael Burry called it roadkill. You know, you're looking for companies they look like they're dead, and you're trying to figure out why they're not. You know, what could turn around in this. And you could do that by individual companies, or you can do that by industries. You know, you could do it by countries. You know, like right now, for instance, we're talking about China for a split second. There's obviously good businesses in China. You know, just because everything's sold off in China, yes, there's the political risk, and obviously the government can get involved, and they've shown what they can do to a business. But all things considered, once something starts to get so cheap that just on a valuation, it starts to look like ridiculous. Maybe you can find that one company that's killing it in China. And because, you know, they always say, you know, you throw the baby out with the bathwater. Let's say I have 50 companies in China, 49 of them probably are, not only are they cheap right now, but they're not super great businesses. But there's that one that really is a great business, and for no reason it's selling off. Well, that might be somewhere to look, because most people probably aren't looking there in the first place, because as everything's selling off, no one wants to look at those ones. Everyone wants to look at the ones that are, you know, hitting 52-week highs and they keep breaking through them, which I understand why. But, you know, if you're looking for a margin of safety, those ones terrify me more, because at some point that party's over. And when something crashes from way up top, it's always a big drop. So that's what you're trying to avoid, especially in my style. I can't take that risk on. I have to find stuff that fits in with my margin of safety in order to take these oversized large positions in terms of concentration. Yeah, but I would say they don't fit the style of deep value, but I bet you could argue that they're value stocks. You know, value is subjective. You know, what you consider value. Even if you go to all kinds of value investors and say, you know, what makes something value, all of them are going to give you, I mean, probably somewhat similar answers, but different. You know, and then there's other ones, like, for instance, this Rev Group, kind of the opposite. I mean, it is generating a lot more revenues than it is to market cap. And you can see it's not like super cheap priced right now, but it trades, a little bit below book value, and it is generating some cash flow and it is generating earnings. So these ones might not be as cheap right now, but sometimes I like to look at these ones because let's say in the next quarter they have a bad earnings and this one sells off, and let's say it sells off 30%. Well, if I can find that it's a good business and it's sold off for, maybe a bunch of one-off reasons, like let's say like ALTO, for instance, when ALTO crashed recently, they had like a bad fire and it messed with they had all these one-off events that really caused the stock to sell off. I'm not saying they're not justified, but at the same time, it doesn't make that all of a sudden interesting, because if they are continuing on the path to productivity and towards profitability that they've been talking about, and those one-off events end, well, now you have something that could bounce back. And, most people are looking at like, oh my gosh, I can't believe that dropped 30%. But, for the few of us who are now looking at it, yeah, it just dropped 30%. This becomes interesting. Like, it's kind of crazy to me that people aren't like, oh, that becomes interesting now. I tend to, as I go through here, over on this side of my notes here, you'll start to see that which ones I've looked at, because I'll have some notes in there. And I do tend to look at some of the more similar ones that I have in the past, but I'm just trying to see, honestly, some of them I look at pretty quick, and, I'm like, nah, I don't see much there, so I kind of move on. But other ones, you never know. Like, real estate, OPAD. I don't usually look at real estate, but that one's sort of interesting. That's an ADR. I don't know where I've looked at that one, but I don't know where they're from. But once again, and that's why not that 52-week lows mean anything, but it's just a way of kind of helping me screen through things, because if I see something and it's right at the top, then it's tough to say that it's cheap right then. No matter what, it's tough to say that it's cheap right then. Maybe it is, but then I'm starting to think more growth than I am value, and I think you're doing a lot of assumptions when you're investing like that. And like I said, if you're able to invest like that and you're able to predict a company's next 5 years pretty accurately, then you're gonna make a killing doing that style, because that's a rare skill, and it's tough to do that over and over. I find you might be able to nail a few things, but then that's kind of why I take outside positions, because I might not find a lot of companies that kind of fit my sweet spot of what I'm looking for in a company, but when I do take a very concentrated position, because they don't come up often, and when I'm right, and you got to take advantage of it. Obviously, as you get bigger, as your sums of money get bigger, it's harder to get in and out of things, so the ability to do that will slow down. But I mean, you can look at big firms who have like $100 million or more, and they still only own 10 stocks, which means that they're probably doing something similar to I'm doing. They have to split it up amongst a few more companies than I do right now, but still, I mean, 10 stocks is nothing when you got like 100 or $500 million or something like that. I mean, that's a pretty concentrated portfolio. Even if and even those guys tend to put, like, let's say 30% in like their top idea. So I mean, it's a lot of money to put into one thing. And on top of that, this is the one thing that most people don't talk about. As a small retail investor, I can look at all these I can look at stuff that's $79 million, $46 million, $40 million, all the way up to $3 billion. It doesn't matter. I can look at all of those, where if you're a big fund, you can't do that. You can't look at a lot of these small ones. It just won't benefit you. For how long do you learn value investing, and did you start the RK style on paper account first? By paper, do you mean like trading, like it wasn't real money? And I've been investing for 3 years, and pretty much immediately once I looked into investing, I just looked at like what are some ways to invest. And when I read value investing, it just like clicked for me immediately. I was like, oh, that's the one I'm going to want to do. And it was probably soon after that I found RK somehow. That was I just kind of stumbled upon him. I don't remember if it was through Wall Street Bets, if I saw a post or something like that, but it might have been Wall Street's value or Wall Street's Bets, because I might have saw this Dayne was deep fucking value, and I might have been like, oh, there's a value guy who likes GameStop, and just tuned in, and then I'm immediately like hooked on, like most people were. I'm like, oh wow, this guy's got like this crazy style. Or I don't know because I don't remember if he posted that he was Roaring Kitty, so I'm not exactly sure how I found it, but in general, it wasn't just RK. It was, like I said, I started finding podcasts and obviously reading about Benjamin Graham and the whole idea of what value investing is. That just made sense to me. It's no different than when you go to buy a car. I'm not someone who's going out to buy the most expensive car. I'm trying to find. I might try and buy a nicer car, but I'm going to try and find a deal on it. I'm not buying it for full price. That's just makes sense to me. I'd rather buy a car with 15,000 miles or whatever you use, kilometers. I don't know where you're from exactly, but let's say just for the U.S., if I'm buying something and it's got 15,000 miles on it and it's 2 years old, but they shaved 30% off the sticker price. Well, okay, that's a deal. That's what I'm looking for. I'm not trying to buy full price and not get and have to pay up for it. I know some people do, but I just don't. I just don't care. I'm happy with getting. I'll take the discount happily. And then I found out about the value investing of stocks is you're trying to do that, but you're trying to find like the junker cars that just need a little shine, and that car might be worth 10 times what you bought it for. So I found a few in there. And I did want to pull up ALTO. Johnny was telling me that there was a new what's it called article about ALTO. I think he said it was pretty bearish, so I wanted to just read up on it. I have, just to be clear, I have pretty much sold out of my entire position at ALTO. I just hold a few shares, but I'm interested in ALTO at these prices, and I really think we're getting to a pivotal point where ALTO can turn around. I give credit for anyone who's kind of stuck through this whole time. I was lucky and sold a decent size of my position before the big crash, and then after the crash, decided to continue to sell out once it crept back up towards like the $2 or $3 or whatever it got back. Oh, it was towards $3. What it got back up to. And that was because I actually had found 2 other companies I was interested in, which is why I moved the cash around. Which is another way to move things. But no, I didn't actually use a paper account. The way I started was I just wouldn't invest as heavily into something as I would now. I would take very small positions and just kind of see how they worked out. The reason why I prefer using actual money versus doing a paper account is because I don't care if it's $10. I don't care if it's $100, if it's $1,000. If you put $5 into a company, if that's like a decent amount of money to you, or whatever that means to you, even if it's not a decent amount, even if it's just a small amount, if you're putting money into something, you're going to start to pay attention. You're going to start to follow it more. It kind of makes you more serious about what you're doing. If I just have a paper account and I can kind of play around, sure, that's great for practice and just to be able to maybe find your style. But I had kind of gotten past that point. I got to the point where I was ready to start practicing. And by practicing, I mean, let's start buying some companies that I value and see how my valuation is. And and when you make a mistake and you're like, oh my gosh, I was thinking this should be $5 or $10 and it trades down to $2. Well, then you sit there and you're like, well, what did I do wrong? What did I get wrong? So, when you start, I might only put let's say $100 into something. But that was just, like I said, I'll put 100 into this. This is what I think, and we'll see how it goes. And then from there, something's down 50% or something's up. It starts to teach you, and then from there, I just started increasing my sizes. And now I'm at the point where I think I'm good enough that I'm confident when I am able to read through a thesis, and after reading like the 10K and kind of learning the news about it, something, and now I'm like, okay, I can really put some money into this, and I'll go heavy. The stops are because I take such concentrated positions, and I still do trunch in and trunch out of things. I definitely trunch out. I'm kind of slow to get out of a company, but the stop is just because usually when I'm buying something, it's already close to what I would consider its low, and if it really starts to break through that low, most likely I'm wrong in my thesis. I may have just gotten in a little early, which is okay too. Sometimes I'm okay with just taking the loss and being like, and that teaches me too. You should have waited further. You should have waited more. Like this downside didn't move enough, and maybe that's where I can get a little better with technicals. Like I said, I find technicals is. You were asking me, what percent of my theory is technical analysis. I wouldn't say it's a percent. It's more like. It's more of like technicals are like one of the last parts of my valuation, and once I've valued something and I've kind of then I'm starting to look into the chart more, and I'm starting to look at general consensus on the stock. I'm reading what other people are saying, how bearish are people, how bullish are people, and when it gets to a point where, like, let's say I'm following a stock and it starts to get really cheap and it kind of goes radio silent, and I'm like, I like this, but just no one's really talking about it. To me, everything looks good, and management says they're about to turn around. If I start to see people talking about it and I start to see it poke out of some of its lows, that's where I'm going to start to maybe trunch into something. So be like, okay, I think this is when it's going to start to begin. And if I'm wrong, it's okay, because like I said, I can be wrong quite a few times as long as I'm right a few times. When you're looking at stocks this volatile, you will see 50% returns. You will. You'll guarantee. You'll see stocks that go up. They double, they triple. They could even be 5 times. I do find it hard to find much more than 3 to 5 baggers, and especially in the current market when stuff is not super cheap. If you're gonna find multi-baggers that are over that, either the time period that you're holding has to be longer, which is tough for some of these companies because they are so small. I find and mind you, I have multiple portfolios too. I have one portfolio for what I consider great companies, and that's more of a traditional value style. And that's something that I might buy and just hold a company. Like, I just like it, and I'm like, I'm going to hold that for a long time. That's probably where, like, NVIDIA would fall for me, is in that portfolio. I didn't get into NVIDIA, so I'm not saying that I'm in NVIDIA by any way. But, when I was looking at NVIDIA when it was around, I think it was around 100 or sub 100. I saw how GPUs were selling. I saw what the market was doing, and I just heard some inklings about how AI and GPUs were transforming AI because of the way they process. I don't know if you know that kind of technical side. I like to build computers, so I'm a huge nerd if you haven't noticed. But with that being said, that like NVIDIA started to look decent there, and then it started to take off, and then I'm like, I'm a little late, and now in hindsight, I'm like, yeah, you were late, all right. You could have bought any of those times. You still probably buy today and it'll go up, but it's okay. I reflect on that and I learned about that, and I'm like, oh, okay. Like, I was right there. That was something good. It was something I knew a little bit more than maybe I thought I did. But those are complicated companies. They're big, and if you go to read a 10K and the company has like 10 businesses basically that it's like doing, like, that's really complicated. And if you have the confidence to build in through something like that, and take the time with it, you can make smart investments. But it's a lot of work, and sometimes, and like you said, you only have so much time. If I became a full-time investor, which, if this continues to work out like it does, then yeah, I would hopefully go to that. Then yeah, I'll spend more time on those things. I'll start delving into even more, even deeper. Right now, I have the benefit of I don't have to dive into something and on every stock. I kind of dive into a few of them, and when there's some things that interest me, I start to dig a little deeper. And if those bring up more things, then I continue to dig. But most companies, I can look at something in 20 minutes, 10 minutes, and be like, nope, not for me. And then other ones, it could, I'm sitting there and I go down the rabbit hole. And like 3 hours later, I'm like, oh my gosh, I'm like, this is nuts. And, for the next like week, I'll be obsessed with it and just kind of going through everything and learning as much as I can about it. That's kind of how BNED's been for me lately. I don't know if you've watched our previous videos on Barnes & Noble Education, but right now that's a stock that, really is at the forefront of my mind. And just trying to predict things and see where things are going. And once again, If I'm wrong on it, it's not the end of the world. I'll take the loss. I've already actually been stop lossed out of it once, so it's rare for me to go back into something once I've taken the stop loss, but I still like the upside here. I still think it's there, and like I said, if I'm wrong, not the end of the world. But I like this one. I'm still confident. I still think there's just too many things that kind of break the bear thesis down in my mind. Yeah, I know, Max. I've said this kind of in the past, but Johnny was the one who really convinced me to start doing the streams. I was okay with just doing this on my own. I enjoy, like I said, I enjoy the process. I was gonna do this either way. I'm someone that, like, if I'm gonna take on something, I like to really kind of go at it and do well on it. And so I was kind of okay with doing this on my own. I don't need to attract people here. I get it. I can find more viewers by posting and hashtags, and we do some stuff. Most of it's just him and I joking around. Like, I don't take the stream super seriously. I do enjoy it. I hope you guys enjoy it. I do want to keep improving and make sure the stream is enjoyable for people. I don't want it to, we always are. You can watch all our shorts. Our shorts are literally just us pointing out all the stupid things we do. Like, if you watch our shorts, you probably think we're just complete morons, because the whole point of them is literally just to point out, like, how constantly we're making mistakes and we must look like idiots. But with that being said, I think just kind of organically the stream will continue to grow. Sure, I might put hashtags in the titles for some of the tickers I'm interested, but I don't need to necessarily just say RK and GameStop. I get it would draw people in, but I don't want to draw people in just for the sake of saying it. Like, I want to draw people in because in, let's say, 2 or 3 years from now, this style continues to work, and people will come because they saw that what we're doing is successful. That's where that would be more rewarding to me. Yeah, that was Johnny's idea to start with the South Park clip, but and then we just kind of ran with that, with the stupid heads and everything on everything that we've been doing. But yeah, it was just I don't know, like we just the first few times that Johnny and I chatted, we hit it off immediately, and we just were joking around a lot. So we just thought, like, in terms of if we were to do the stream, like, what would be something that could make it our own. And we just thought, like, let's just kind of make it just fun, not super serious, because that was never the goal. It was never to be super serious. Like I said, really, this is partly for entertainment. It's partly for education. Yeah, it just kind of worked out like that. But yeah, I mean, it's so far it's been enjoyable. Like I said, it's nice to have guys like you, Max, on here talking. I appreciate you guys coming on and spending time on here. Because it is when it's just you on the computer doing this for hours, like, it is kind of boring at times. Like, it's kind of lonely. It's not, like, boring's the wrong word. It's work. It's more like how, like, even if you enjoy your work is work. So it's just its own thing. But the stream kind of adds something to it, gives us something to look forward to. I like to, unlike our case, it's Johnny and I. So I do my own stream. Johnny does his stream. I get to watch his stream and see what he's talking about. And I get to watch Johnny improve as an investor. We're both coming from different paths. We're both learning as we're going. He gets to watch me improve. I get to watch him improve. And then, on the weekends when we do the stream together, it's just fun to talk things out. It's good to, compare ideas and whatnot. And I think that's one thing that does make ours slightly unique to our case, is that the fact that there's both of us doing it. Just trying to see if there's anything else I see here right now. Yeah, I think that's a decent list for right now. All right, last thing, I just want to get over to the insiders. Oh, it's 8:50, man. We're talking. Missed because of not seeing it or seeing it too late. And where did you and Johnny meet? How many opportunities you think you missed because of not seeing it? So, in terms of opportunities, like where I really think I missed it, there's a few. I have no idea the number, but this is why in my database. So I put everything into the database. Every stock, if I'm going to go into even a little bit, I'll put it in here. I'll put a somewhat of evaluation and just kind of mark when I looked at it. And then from here, if there's something that becomes more interesting to me, I'll put it on deck, which means it goes to this next one. So this is all stuff I find somewhat interesting. It's, you know, there's something about it that interests me. So this is one way I can use this to scroll through, like, how many stocks are in here? There's like 275 or 76. So this helps me to narrow it down. So, you know, I start with over 1,000. This kind of narrows it down to there. And then up here, I put stuff in my watch list. And I do have to go through this again. So this isn't totally up to date. It's tough to always keep this all up to date. But these are ones that even more interest me. There's even more going on with the story. It's trying to stay organized when you're looking at over 1,000 stocks. This is ways I can do it where I don't find I'm missing as much. Like one awesome tool of Excel is you can sort by the data. So I can take this list here, and I know this isn't. Let's do it with the on deck one because it shows my point more. But like let's say I wanted to just find stuff that's close to what my buy range was. I can select that there, go to data, I can go to filter, and then I can go to my buy value here. I can filter by color, let's say, and we'll say ones that are truly green I can filter by, and it will just eliminate these, and there's just a few left where these are well into my buy zone last time I looked at them. Now I might pull these up and totally have changed my valuation, like, you know, some of these are gone or whatever they are, you know, or probably most of these ones are dead because usually that's why the valuation looks so good because they're so cheap. Probably something's went wrong with them. But, you know, it was somewhat of a compelling story. So this is ways I can kind of filter through here and find things without, just trying to stay organized. That way I'm not missing stuff as often. You know, you do have to stay up on it. You do have to pay attention. But yeah, I'm going to miss stuff. But the more organized I can stay, and the more, the easier I can keep that stuff filtered. I'm just checking those few stocks that interest me initially. I'm just able to keep them in my mind and make sure that I'm double checking those ones more often than the rest. So that's how I kind of manage not forgetting about ones that I did like as I'm looking through. You know, each week I'm looking at over 20 stocks. I probably look at an average about 25 to 30 stocks a week. And like I said, probably 25 of those don't really interest me, but maybe 5 of them do. And then from that, other than that, you know, as I find, like, let's say I'm sitting here and I'm kind of bored and I didn't find much on one night, then I'll go through my watch list and I'll double check all those. I'll go through my on decks. I might pull just some charts up, just look at charts to see, is there anything I can see on there? Because if you know the business, it's a lot easier to look at a chart when I already kind of know what's going on with the business or what I think's happening with the business. And then we met in a forum actually on Reddit that was about building spreadsheets like RK had. I don't remember how I stumbled upon the actual Reddit, but I probably was Googling something or on Reddit trying to find an answer to something. And, you know, that got me on there. And I was already building the spreadsheets when I first found it. So then I knew what it was like to have to build these spreadsheets and to learn this. It's a lot. And I don't think most people are going to sit there and spend, you know, the hours. I'm talking, it took me probably a full year to build out the basics of these. I had to learn. I talk about books that I read. I read gigantic textbooks learning Excel in VBA. And from there, once I got this build, I was happy to help other people because I know what it's like to be sitting there trying to think out things. And I think me and Johnny met in just one of those. He had asked me a question or I asked him a question. And we just started spitting ideas back and forth. And then we got talking. It probably took me a full year to actually build out the spreadsheets. But I took it on kind of as like I knew it was going to be like a long-term thing. So after the arcade streams and after the whole GameStop thing had ended, I knew I was going to be interested in investing, and I knew I was going to want to start doing my own style of investing. And the immediately problem I ran into is, even with all these different websites, I had tried Morningstar, using FinViz, and like some of the other names. The data, it just wasn't enough. I wasn't able to buy something with any kind of real confidence. I didn't feel like I knew them like I should have. So as I watched RK's streams more, I'm like, I see why he built out the spreadsheets. Like, this is a way to really check and answer all those questions you have about a business, and or as best as possible. So I was like, I think I need to just try and build the spreadsheets. And from there, it started as just kind of a small project to just kind of get some stuff started. And then once I started to really learn Excel, then it was just like only a matter of time. And then once you start to get like a few parts of it working, then it's like, oh, great, this is awesome. And like with every new part you add in, it just makes it that much better, where you're like, okay, like now I got this running, and then next I want to build this out so I can learn how to do these. I know a lot of people hadn't built out the fundamental spreadsheet, which this was one I knew was going to be super important, because you need a way to break the data down as a value investor. If you're not going to pay for some service, and kind of like RK said, the way the other services have the information splayed out, I don't know, like it's not really well done in terms of like how I want to look at a company. Like here, when I look at these financials now, it's like reading a book. Like I can quickly scroll through here and get a pretty good idea of what's going on with a company without even reading anything about the company, just by looking at these numbers. Then from there, I can delve into all my other questions I have based on what I see here. But this immediately just kind of gives me an idea of where this company's at in its position, and then from there, then it's digging into each one individually, checking 10Ks, 10Qs, checking seeking, checking who owns it, all that kind of stuff. So it's kind of a hodgepodge that's turned into this style. But all right, here. Let's see if there's anything else. You start to learn like financials. I tend to not look at too many of the financials. I just don't find, like I said, I'm looking for stocks that can give me 50% returns. So sometimes it's tough on those ones to find that. And then obviously, like, you look at like Kimberly-Clark Corp, and the market cap's 41. It's so big. It's going to be tough for that to continue to grow at those levels in the time frame that I want. Maybe over the course of like 10 years, but if you're up 100% over 10 years, I mean, don't get me wrong, a 10% return's not bad. It's that's what you want, but like that's not. I'm not going to spend my time looking at those, because it's just, I'm not going to find what I need. That's the other thing too, is I think my overall spreadsheet pulls in like 8,000 different companies, and I probably, if I was able to look at all of those and just say which ones interest me, I could probably eliminate like 5,000 of those almost immediately. Let's say there's maybe 2,000 or 3,000 stocks that would interest me, and then most of them aren't cheap enough, or most of them look bankrupt automatically, or they don't have any earnings or any revenues even, for that matter. So those ones are tough for me to get much. So like I said, then it starts to narrow down. I imagine probably about 2,000 stocks is probably where I'll end at some point. But I even got to go through and eliminate stuff, because like I said, stuff's gotten merged or bankrupt or whatever. But I mean, PBF, this is when I said that I really like this company. And it's not even like it's close. It's 10% from the 52-week high, but if you just look at what this company's doing, I mean, they're doing everything management should be doing. They're buying back shares. They're I'm pretty sure they're paying a dividend. They're generating a ridiculous amount of cash flow that's like, no, and earnings even for that matter, that no one seems to care about. And massive insider buys recently. I wish, I don't know. I wish it would have just a little pullback here. If it got down into the low 40s, it would really interest me. But that's part of my margin of safety too. Like, I don't know. It's just a little pricey for me, but it trades pretty cheap on a lot of different metrics for me. And the metrics are just one thing. I just think it's a well-run business, really. It comes down to that more so. All right, so to finally get this started, that's good. Looks like I got 9 companies, so we got a decent little list of things to look at here. I did want to change Loom because I wanted to just pull up ALTO one more time, although I gotta enable this here. So we'll update the whole. This will pull in all my information for all these different tickers. But it obviously takes a second to pull it in. I do use share radar data. So I only get 10 years. RK used... Gary, I'd have to pull that up real quick to see what their margins were. I honestly, I don't remember much. I should know that, but I'd have to double check what their margins were. Maybe you could argue that's the negative side of it, is if the margins are thin, and if it's a cyclical business, all it has to take is one step back, and it's it cripples like cash flows and makes all the metrics look really bad very quickly. So it's a good point to bring up. But we could pull them up too. But I would imagine their margins can't be too terrible based on those metrics. Actually, I do have gross. I mean, I have gross margin and all that listed in here. Let me see what's. Let me see what it says on here. Where's PBF? 8 net margin 7%. EBIT is 11. Cash flow from operations 5%. So yeah, not like crazy high, but I get what you're saying. The other thing with PBF, it's more also if you compare it to other companies in the industry, it's performing well to how cheap it is. There's another thing that I thought was cool that I was able to build out. So I have it. So like for like PBF, I can just click here, which will bring me over into my industry filter. Sorry, this is zoomed way in. I'm not used to looking at things. I transfer this over to my laptop a lot, so I zoom way in. But it'll pull in all these other tickers, and then I can just kind of compare PBF to some of these other ones and see what's going on there. Obviously, the insider buy was the first thing that triggered me to look at PBF was that insider buy. But on a cash flow operations, it's kind of right in the mix there. On a book value, it's one of the cheapest. There's only 2 other companies for a tangible book value that are cheaper. On an EBITDA to EV, it's the 3rd cheapest. So yeah, Gary, that's kind of all the little things that had just kind of made it pop into my mind just when I was looking at it. And that's the other thing too. I looked at so many companies, recently that like. It's rare that one looks to me like it's trading pretty cheap in comparison to some of those things at that level. Just, and it's not super cheap, but it is cheap to me. Like I think if I go to my database here, let me see what I valued it at. If it continues at this level, I thought it could be worth almost $90. So, obviously I thought there was some upside, but that's why I kind of wanted to, I wanted to pull back a little bit before I was to invest in it. But I thought it was interesting. I think there was also some relatively bullish sentiment towards the stock. Obviously there's the insider buy. I think there was owners. I didn't write that there was an owner, but I think I might have saw that someone was involved, but I'd have to double check that too. All right, this should all be pulled up. But I think I just wanted to check because Johnny I think said there was an article about ALTO. Yeah, he said it was a bullish article or a bearish article. So I like to read these because, you know, and like I said, I'm not in ALTO right now. So it's interesting he says facing challenge given weak ethanol crush margins. I thought the crush margins were doing good recently. Not like crazy good, but they were improving. And anything I saw Justin from Domo Capital had posted that that there was like a ton of excess corn, so like it's gonna be bullish for that. Yeah, I know this. So companies currently negotiating contracts to first build a natural gas pipeline to its main facilities, get better access to natural gas at an incremental of $3 million in EBITDA. The carbon capture and sequestration opportunity with 45Q tax incentive company sees this as a $30 million a year EBITDA opportunity just from the tax credits. That's the other big thing too. I just listened to the Business Brew and I think Kyle Morey's his name was on there, and he's real big into all the sustainable aviation fuel or SAFs. And ALTO would be a company that could greatly benefit from this tax incentive that the companies would see. The United States government's going to give out like massive bonuses to these companies who start to put towards the CapEx towards making these products. Because I think the United States is trying to go carbon zero or carbon neutral, I think by 2050. So they're trying to spur it by throwing money into these things. And regardless of whether you think it matters if we go carbon neutral or not, that's what they're pushing for, and that's the money that's going to be there. So 30 million in extra EBITDA would be a lot. Let me where's my fundamental tab here? Do I have just EBITDA? Yeah, I mean, you're talking, you know, highest EBITDA this company's ever had is $55 million, so $30 million in EBITDA. I mean, that's a lot. That would be a big change for a company, even if it's not permanent. You know, just every once, just having that injected for even a little bit of time. And I mean, they're saying the project's expected to be operational in 2027, but obviously, if that's gonna come down the pipeline, people start to price that in earlier on. This is the other thing too, is like you have to know that like if something's gonna start to happen in 2027, like you kind of have to start to plan to price that in now, because the stock price will by the time we get to 2027, it will already be priced in. You know, I'm not a big fan of efficient market theory, but people aren't dumb. You know, people are gonna start to be like, okay, they're gonna get 30 million extra in EBITDA. Like we should start planning on that. That's gonna be a thing. So he's saying the company could add 125 million in EBITDA, and I know it's EBITDA, but still, I mean, that all breaks down into other different things. It's funny he's saying all this, and I'm wondering where his risk is, because everything he said so far is like all these bullish reasons. I always think it's funny when people write articles, but the whole like chunk of it, like you're supposed to do it the other way around. You're supposed to write all the bearish things about it, and then you write what the guys are saying are bullish, and then you show why they're wrong. There's people who write these articles and they do it, in my mind, the wrong way around. So I'm like, are you bullish or bearish? And obviously, yes, the crush margins matter. That's huge because that affects their business. I think they're positive right now, though. And I get it. Management's last earnings or transcript, it was a nightmare. The earnings, everything was a nightmare. So I think I don't remember if Q4 is going to be anything too crazy, but I don't know. I thought the crush margins were looking better. Last I had looked, everything was slowly trickling up. It wasn't anything crazy, but they were becoming positive. And yeah, I want to know where he's getting this data from. Yeah, because the crush margin right now is at 4 cents. Sure, I have ALTO doing around 20 EPS, 25 million of EBITDA for Q4 23. Cash flow will probably look worse given continued investments in their new projects. Cash flow will look worse because they're spending on CapEx. This is why I tend to look at cash flow from operations, though, and then I plan, if they're going to spend on CapEx, like how much will that benefit? But sometimes free cash flow, I feel like, can be biased just because if you're just looking at the number, it's tough to use it. Because sometimes it's going to look worse when they're using a lot of CapEx, but it's in the future that it's going to look great, because all of a sudden they're not using CapEx and they have a ton of extra cash from the business that generated. Which is fairly normal seasonality. We'll see where they go as 2024 progresses. As you say, the growth projects have missed their targets so far and costs have gone up, so keep an eye on this. All will be key. Yeah, that article's not. I'm a little confused on this one, and I've read some of I don't know if it's Jeffrey or Joffrey's stuff, and he has had some good articles. So I don't know, maybe he's just mistaken on that one. But all right, we can continue on here. So, this was FSKR. I pretty much brought FSKR in just because I saw the short interest was insane, but it's probably dead. I mean, look at this. So, this is one thing I thought was cool that RK had built out, and it's like a deleverage calculator basically. So, it just looks at either cash flow or net common assets to net common overhang, and it just kind of calculates and says like, hey, at this rate, based on currently where they're standing, like you're going to have to dilute shareholders by X amount. And then if you do that, what does that do to all the metrics and kind of adjust the valuation based on that? So I do have, even with that being said, and all that extra cash generated. Now, you see it's trying to tell me I need 4 billion shares. So it's really levered. If we go over to our 1-year data, well, I mean, it's not great. If they really have 625 million on cash, that's a lot of cash. Granted, they're burning a lot of cash, but that's still a lot of cash. That is a lot of debt too, obviously. But short-term debt's only 18, which makes me say. So this is what I'm saying, Max. So like I said, like how you can read this now. Obviously, cash flow is ugly. Even on this is a 7-year basis, which I don't have quite that much data. But even on a 3-year basis, we're at minus 10 cents. So for every share, they're just losing 10 cents a share of cash flow on average, per trailing 12 month every time this gets updated. Book value continues to decline. So obviously, this isn't profitable much so yet, and I don't know why revenues is 0. This is the other thing too. Sometimes I got to double check these things because my data sometimes from Share Radar is not perfect. The years are right on here. So I just like to pull in the latest, like a 10Q or 10K, whatever's more recent, and then just to see how their numbers compare to mine. So they got 527 currently. They don't have a ton of lease liabilities. But that's so. They don't actually have any actual debt? Because this is what I'm saying. So like the debt looks just total non-current liabilities. What are these total non-current liabilities? Because right now it's just saying the only debt that they have current is just the leases. No, okay, convertible senior notes. These are due 2026. So this is what I'm talking about, Max, when you go into this, if you're still here. When you go into here, you know, so I see an aggregate of 667.5 million principal at 2.5%, convertible senior notes due in September 2026. So in 2026, I know they need to have 665. I just saw that their cash currently, as of this September 30th, is 527. My data said it's on 930. So with that being said, this number is probably slightly off. And mine actually is supposed to take a little bit of okay. Thank you, Max. My data actually takes a little bit of the cash off, just because you need cash for certain things. So I don't like to say they have all their cash available. It matters more for companies that are much smaller within this with their cash. But so like I'm looking at those things and I'm like, that gives me an idea of kind of what's going on. This business obviously is not successful. Now I know why the short interest is so high. It looks ugly. One quick thing I should have done, and I've already looked at it, but is building a technology-enabled asset-light automotive business model for the automotive industry. Companies focused on vehicle development and sales and services. It's involved in developing and designing electric vehicles. Their FSKR flexible platform agnostic design. What a terrible name. Is a process that allows the design and development of a vehicle to be adapted to any given EV platform in any specific segment size. Its segments include white space, value segment, and conservative premium segment. Company intends to market and sell its vehicles directly to customers using its digital platforms, including the Flexi app and website. The company has not generated any revenue, which actually currently isn't necessarily true, because now it's saying in this last bit they did generate revenue. So obviously it's really young. Even though it does have some years of data, it's a young company. So like that's part of the risk, is like this is too young. It doesn't have a lot of information. Obviously all this free cash flow stuff is going to look terrible because it's still trying to grow. You can see, I mean, we went from 50 million shares to now we have 343 million shares. So they've diluted multiple times. So shareholders, if you bought this towards the start, which, I mean, I don't even have to look at a chart. I can just guess this is what's going on with the chart. It's going to fall off. We go to a 5-year chart and you can see, I mean, it came out just like most IPOs did in the past. Now that we're in a tougher rate environment, companies like this, it's super tough to restructure and stuff like this. That there's a huge risk. But who knows? This one may be interesting, because this is where you need to start following the story and figure out what's going on with it. So we know it's just starting to get maybe some car sales going on, just starting to generate some revenues. Hasn't really done anything productive, and it's close to the point that the dilution's either going to become more insane and this is going to continue to drop. Now they're below the $1 mark to stay public. So that becomes a concern, because a lot of companies, when they get delisted, that tends to lower liquidity, which tends to lower interest. So these are all things that start to flow through your head when you're looking at these. Immediately, like the first article is FSKR potential trouble brewing. But, this is why you were talking, does short interest me? Well, can I find any way that this can turn around? Because let's say, as I read through here, I come to some conclusion that over the next year they're going to survive, that, they can restructure their debt, and it's a 50% short interest. Yeah, you want to see a short interest like squeeze? That's how those kind of things occur. Super rare, obviously, because the reason why people are shorting this is because they don't see any way this turns around. So they're probably right, but it's your job to this is, as an investor, this is when we should delve in and figure out what's going on here. So this is one thing that's super important too, is how good is management in these situations. So we can tell right now, FSKR fell well short of its 2023 production and delivery goals, producing only 10,000 units of its Ocean SUV. So, the company's revenue for 2023 is expected to be around 376 million, significantly lower than the initial estimate of nearly $2 billion. So right now, management missed estimates by, what is that, like 80%? So that starts to tell you that management now is probably overshooting and overselling the idea of where they're going to be at. You know, I get why they do it, because they don't want it to crash, and obviously they can't afford a lot of bad news. But now I'm starting to be like, okay, well, I can't take management super seriously, because they obviously are going to just tell you what you want to hear. They're praying that you just go with it. Interestingly enough, it says short interest on here is 28%, so it might not be as high, or it may have changed since whatever we looked at on the other one, because I think that said it's almost 50%. So, but like I said too, also it's getting down to 80 cents. You know, once you get below the dollar, I'm sorry, if you're a short investor, that's not where you add on. You start selling your short. You know, you start getting, or you buy back your shares and get out of your position. So we're talking overall demand. You know, the EV market's tough right now because it's not just them, it's the entire EV market. So that's another thing too. Not that I take macro ideas totally into concern, but I am going to pay attention, because if the macro environment for EVs in general isn't great, well, then that means that this company is going to struggle even more so, because they're also like a small name. They've lowered their pricing options. So on the Ocean Extreme from 68 to 61. So now margins are starting to get crunched. So with a little bit more, so this is also to answer your question, Max. Finished Q3 with a little more than $500 million in cash, but it also had nearly $1.2 billion in principal debt on the balance sheet. The company's earning release statement stated it could raise another $550 million in proceeds through debt as part of one of the last year's agreements. However, cash burn in Q3 was $330 million alone, just in the one quarter. So this is where you start to just do some basic math and see that it could possibly look ugly. You know, when is this article from? This is recent, January 4. He said there was a price target, though. Someone had said it must be some of these analysts, at 375. So obviously that's pretty bullish. Or is he saying from his? I don't know if this was his price target. You know, he's saying that someone said it could be worth $11, but you know, I mean, based on what? What would make you say this is worth $11 right now? And he said he downgrades it to a sell. Stock finds a way to fall below $1. Possibility of a reverse split could become another negative catalyst as well. A reverse split's, you know, not great in terms of makes your margins even worse, essentially, in terms of as a shareholder. But it does bump your price back up above the dollar. That's why they do it. Yeah, I mean, this all looks negative to me. So, like, you know, in terms of, is this a stock I can be interested in? Yeah, it's not that it's not like it's nothing, but it's also, there's not enough there too for me to really take this one much further. So I'll go to FSKR here. Just kind of update here. My current valuation said 99 cents, so I'll stick with that. That's fine with me. But obviously there's some real risk here. And then I'll just calculate a little bit if I wanted to get my margin of safety here. You know, burning through cash. My little notes here just say that it's, you know, it's too young. It's no earnings yet. Needs more. It's too expensive currently. I could take too expensive out because it's not there, but it's going to need a turnaround. And I want to say poor management as well. These little like things I put in here. It's just some of these like hyper like ideas here, and these are just quick notes for me, so I don't have to write things out. I don't have time to sit here and write stuff out. So, I didn't see much going on there. There was the insider buy. These guys bought at 680. So, I mean, it doesn't mean anything to me. I mean, this was a terrible buy is what that was. But it looks like they had sold too. So, I don't know. It's something weird's going on there because they're saying multiple transactions in the filing. So, who knows exactly what happened with this one. But either way, I mean, it's nothing. So, we can move on to the next one. The old CODA Octopus Group, through its wholly owned subsidiaries, it operates a marine technology business and the marine engineering business. Its tech business is a solution provider to the subsea and underwater market. It owns technology including real-time volumetric imaging sonar tech, diving tech, which is applicable to the underwater defense and commercial markets. Its imaging sonar products and solutions are marketed under the name Echoscope and Echoscope Pipe. Its diving technology is the Diver Augmented Vision Display, or DAVID. It's suppliers of embedded solutions, sub-assemblies which they design, manufacture, and sell into integrated defense systems such as close-in weapon systems. These guys build like submarine weapons and stuff. So interesting, a lot of different stuff here. I know my data is off automatically because I don't have 20 years of data, so I got to just adjust something real quick. Just change it to say that I only need my data for the quarter here. I don't need it for a year. There, that looks a little bit better. It's a small market cap. But so just looking at the last company, like versus look at this one. I mean, this one looks way better. We have an improving book value. It's considered safe, which is rare for me. This has cash, and I don't think it has any debt. I think it's negative. So 0 debt on its book. It's a net working cash positive, which is that's like a tried and true valuation metric. It's trading at 548, which is it's high, but it's high because it's like a safe business. This is why I said too, like businesses that are safe are going to tend to trade high, which if you wanted to project growth out, if it continues at these levels over time, and this free, they're able to keep returning money to shareholders, retained earnings to assets are almost becoming positive, but they're drastically improving. I mean, they're starting to slowly get money back for shareholders. They don't pay a dividend, but they are sitting on cash. I mean, they got 24 million of cash, and they actually keep building up their cash position. So I got to figure out too, what are they going to do with that cash? How is that going to get returned to shareholders? Are they gonna buy shares back? Are they going to maybe possibly offer a dividend? Or if they just keep investing in the business, how productive is that? They are investing. They're spending on capex. It looks like not a ton. Just like a few, like 1 or 2 million. It looks like each year into capital expenditures. And we got to figure out too, what's the upside of the business? How big can this get? So, but overall, I mean, it doesn't look bad. There's some insider buys going on here. Not a ton in terms of the quantity, but these two own a lot of the shares. So these guys own, about 4.5 million shares, and I think that the company only had 11 million shares. So they're obviously big owners. I can see if anybody else owns it. I'm going to start to close out of some of these tabs because it gets a little ridiculous here. This isn't even the right ticker. This is one thing you gotta be careful when it pulls up. I gotta just type in just CODA here. Of course, it doesn't have the data for him. It's a pain. All right, we can see what anyone's talking about. We'll see what anyone's saying. Yeah, it's like the first time I even got to look at the chart. It's like just here, but that's because, like I said, the chart for me tends to be later. Not so interested just right now. You know, it's also nice too for me to go through real quick and just get an idea of that information from just the fundamentals, and then to come here and see, you know, valuation is now reasonable, but growth remains a concern. That's kind of already what I was thinking. You know, I'm kind of saying like, okay, I'm not saying the valuation's not fine. Like at $5, that's reasonable. It's more than I would pay only because like I said, I have a very conservative margin of safety that I look at. So it doesn't mean that, I wouldn't overspend too if it's a really good company. You know, some things just aren't going to get that cheap if they're really that good. You have to just kind of pay up a little bit, or wait for something to change things. But not too long ago, it said David to drive significant growth, stock still undervalued after a 50% jump. So that must have been somewhere in here. Or that was April. What is this? This is a 1 year. Just trying to get a little bit idea of back here. So it's kind of always traded at this. So that's the other thing too. And like, like I said, my valuation says it should be worth, where was it? I get 435 right now. So that's obviously a little bit below, but the chart never has really dropped that far down too. So when I talk about, how much do I take technical analysis in, I'll just take into account, like, even though my valuation says that, the market's always, even at the lowest, has traded above that. So, maybe I should just add a little bit of that into the numbers. And I do partly calculate that. I do take a little bit of the 52-week high and low into my numbers in my evaluation. Because, my valuations are kind of, they're not, I'm not trying to be super accurate. I'm just trying to get a ballpark number. So earnings results, but dropped after the Q2 2023 report, providing a potentially attractive entry point. He's saying 20%, got up to 989. This is from June, around this article's from June, so it was a little old, but it's sometimes it's interesting to see what they say towards the end. Honestly, some of the times the way these articles are written, like, I'm not going to learn too much about what's actually going on here. He's talking about, given the historical financial performance, and in order to be conservative, I will assign a 70% chance. The worst case, okay, whatever, I don't. He's using enterprise value, which is fine. He thinks over the next 4.5 years, it would be 145%, or about 20% per year. So he's just saying the actual David and Echo Scope growth potential. So that now tells me I should probably look at like a transcript, and from there figure out what management's saying in terms of what they think the numbers will look at. How has management been in the past? Have they been accurate or not? If they're not accurate, then like you just saw with Fisker, like if they're way off on their reports, then you really can't trust what they say going forward. They don't know, or they're trying to make it look better than it is. So, he's saying it's a liquid, but to me, that's no problem. Sometimes I feel like some of the best opportunities are in relatively illiquid stocks currently. It's when the volume explodes all of a sudden after you're in it already. So he's just saying that the growth outlook could possibly... So what he's saying is this kind of leads to me saying, like, I like the business here. I'm not saying anything's wrong with this and there's possible growth here, but this would have to get cheaper for me to be interested. So this is one that, like... I don't not like the business, but for me, looking in, like, I'm trying to find outsized returns. This isn't going to be it for me. So we'll hop back to the fundamentals. You can see last time, if it's orange here, that means I put it on deck, which means last time I looked at it, I liked the business. So, take it for what that's worth. So we'll go just on here and just update it real quick in my database. I looked at it about a year ago. I said 634 last time, so you can see, my valuation changes slowly over time anyways. I said good fundamentals, low debt, too expensive and on deck. I'm going to say need more. It does have insider, and I don't think I'm going to put it in here, but I'm just going to question growth of David and Echo, which are their two main products. We'll bump this valuation down a little bit. And like I said, so obviously I can't go in on everything. if it's too expensive, and I would get interested around $3. And I know that's really steep, and it's never been down that far, and it probably won't get that far. But it's gonna have to really grow. And like I said, this is why growth for me. I'm gonna actually bump up my confidence back then. I only put a 2 with the insider, and overall, I kind of think that this is fairly valued at like probably $5 is a good fair valuation. I'm pretty confident on that, so I'm gonna put a 4. And that just means that if all things stay the same, let's say for some reason that, for whatever reason, the stock sold off. Let's say like Max, when we were talking like the coronavirus thing sold off. Like, let's say this thing for some reason trades to like $1. Well, if I'm pretty confident this is worth $5, even in a rough environment, let's say like I think the products will continue to sell. Well, this could be a 3, 4, 5 bagger at $1. Obviously it's going to take something to get it down there, but I'm pretty confident in the fact that I think this is probably worth about $5, all things considered. All right, so that's CODA. It's already 9:37. Darn it, I'm going a little bit over time. And normally I only go till about 9:30 on these nights, just because I got work and everything tomorrow. But let's see if there's anything I can find Expensify. I'll probably wrap it up after this one. So obviously this one doesn't have a ton of years of data. So these ones also a little bit harder to value when you don't have a ton of years. Obviously you can be quite a bit off, and or the business just hasn't had much time to really prove itself. Just real quick, while I'm doing this, I'm just going to pull up PBF, because before I get off, I did want to just check their margins that Gary had mentioned. Yeah, I mean, sorry, Gary. I'm getting to you, man. I won't forget you. But this is what's problem. I got a million things in my head going. I feel like at all times I'm trying to. Yeah, so you're right. I mean, historically, and maybe this is what I was looking at is right now, and not only do the margins look good now, but revenues are up. Revenues are up pretty good, and yes, they're down a little bit from last year. But still, on average, we're still moving in an upper direction here. So and these are 3-year average ones. So if we go to the single years, you can just tell the entire business for the past few years, if we're just looking at these, has been improving. So yeah, they are low. So obviously, maybe we want a little bit more data or time to see where this goes. But I mean, that's kind of where sometimes I can kind of weigh on like this kind of insider. I mean, that's a lot of money for people to be putting into this, and it's just that one guy, to put that much money into something. They're repaying. They're starting to pay their dividend again. I mean, book value is starting to really creep up. I mean, I get book value at $55 now, and they don't have a ton of debt. They have a lot of cash. I mean, all these things to me, I see a company like this comparative to some of the other ones. Like you go from this, to like Fisker, and it's just ugly, and you're trying to figure out like, okay, what can I find in this one? Yeah, good point out though. You are right though. I mean, this historically has run with not even I wouldn't even say good margins. It's run pretty ugly actually. It's just made it through, which might be why you're starting to really see the business. But that also, Gary, interests me, because if margins only, I mean, if they improve, let's say 3 to 4 to 5%, and you get this kind of change in what's happening in the business, I mean, that means just a little bit change in margins really good for this business. So just something to think about. It is a little big for me too in terms. I mean, we'll have to see. And if you look at a chart historically, obviously bottoms would be like this is probably why I said and like I said, even if you want to look at like technicals, like I was just saying in terms of like me not using technical analysis much. I don't use much, but if I want to just draw some lines of support and resistance, like you can argue those are some pretty obvious ones. So, you get around like this $45 mark, to me, it definitely becomes interested if it was to drop back down. Obviously, this breakout, this might go even higher. And if it starts to break through at this level, it might be a missed opportunity for me, which not the end of the world, but now a company in the future I'll keep my mind on, and if I see another similar type oil company that's in the refining business that's doing something similar and gets these kind of numbers, it will interest me. But you can see even on the 5-year chart, when margins were, but this is the thing, Gary, even when margins were poor, book value and everything was so much cheaper. Look where this traded price wise. It's gotten. Is this COVID? No, this is before COVID, and maybe oil prices were high. That's some things you have to compare real quick too. So if I just pull up oil, was it a 10-year chart? Is that what I had on here? So this is the 10-year chart. So it wasn't even like oil was trading crazy high though when PBF was getting all these benefits. So. I would argue that, and they were paying a nice dividend, $1.20. It's not like a great dividend, but like they're paying it, and even during those years, they were slightly diluting shareholders. They are still diluting a little bit. So, but debt was much higher back then too. Not back in 17 and 18. But it did peak here, and now we're paying that back down, which that's good to management for me. But all right, back to Expensify. This one shouldn't take long because I don't think there's too much going on here. Like I said, it's pretty young. But yeah, that's kind of when I look at it, Gary. Like it just looks good to me. It's like it's. I wouldn't say that's a traditional value stock per se, but the way I value that one, I can start to see a little bit of growth into it. I can just say historically it looks kind of cheap comparison to where it was trading before based on today's fundamentals. And I get it. It's going to be somewhat cyclical. So maybe I'd be wrong. Maybe I'd be buying at the top. Who knows? But just with how much like revenues and stuff have improved, it looks to me like the business is fundamentally doing better. So they got 66 in debt, so not too crazy in debt. They haven't really diluted much. So, obviously they have no earnings yet. So still a young company. Trying to figure out what's going on here. We'll just, I'm sure a lot of people have heard of Expensify, but it's a cloud-based expense management software platform that helps businesses to simplify the way they manage money. This platform is used by people and organizations around the world to scan and reimburse receipts from all kinds of different things. It improves the experience of the actual end user of the expense management software. It's enabled to serve employees of all types and organizations of all sizes, industries, and geographies. This is just kind of blah, blah, blah. Basically services. It offers all kinds of services that, businesses that can use. Ways that they can model their capital efficiency and make it scalable. So, with a company like this too, obviously it's proof of concept. Insider buying, which is, one of the things that immediately, interests me. It's a big shareholder, 10%, 10 at $1.76. What is it trading at? It's $1.66 right now. This is when I'll pull up the yeah, that's true, Gary. I feel like a lot of stuff is priced in well. But there is companies I find that aren't. PBF's one. I like BRY. I like GTE. Some like GTN, for instance, has it's obviously discounted because a big part of the business is in Colombia, and you have to take that into account. But that's another company. They're doing buybacks. Business looks good. So it's just one of those things that just takes time. This is a typical IPO chart, just straight down. So, but this is another one, Max. Sometimes that can be interesting. Sometimes it's tough. It's tough to figure out where the overall market will consider all of a sudden this. Yeah, of course, Gary. This is one that once it gets down low like this, you might see it pop up here, but they're really tough to time on these. But it's basically, it's going to start to trend down so far that basically they're arguing that this company is going to go bankrupt, and then it's up to you as an investor to be like, at a certain price, it's already priced for bankruptcy, and if it's not going to go bankrupt, you can get that cigar butt type bounce. So even companies like this where there's not much to go on. In terms of cash flow, they did have 11 cents per share based on my metrics, which isn't diluted yet. My even though it says on my calculation that it's levered, it hasn't said to issue any shares. And mine actually says even currently, and it's because the debt's still kind of low and they haven't issued a ton of shares, that it could be worth $2.33. The only problem though is book value came up and now it's back down. So if that continues, I'd probably want to wait for a little bit more data. And like I said, with 3 years of data, it's hard to take my valuation calculator very seriously because it's just not much to go off of. Let's see if anyone's talking about this one. So today, this is from December 12th. Donovan Jones, he writes a lot of articles on Seeking. Yeah, he looks at a lot of IPOs, so this is just probably him following up because it's still a relatively new business. So the thing is, too, is it's like it's preparing to launch. See, this is one thing that kind of scares me. The company's preparing to launch its new EXFY 2.0 platform, which combines features similar to that of WhatsApp and Venmo. And, WhatsApp and Venmo are both, good products and stuff. And I get that EXFY might have a niche in there, but there's a lot of competition in this with tech. Just to get people to accept new technology, to be like, no, our whole business, like let's say you have $100 million business and you're like, all right, we're gonna use EXFY's product. Like that's a big decision to make. So you have to really sell this. But the other thing about that is if you're able to sell it to a few businesses that can tout your program and prove its success, you can scale those up pretty quick too. So it's good and bad, which is why you just kind of have to follow it. New founder David C. Barrett, who has been with the company since its inception, was previously the engineering lead for Red Swoosh. It's a person-to-person file sharing company. The company's primary offerings exclude, a bunch of different things that are obvious with, money-type apps. The company seeks free trial and paid subscriptions through its online self-service platform that it markets through online advertising, social media, and word of mouth. So, obviously they have to spend on advertisement. The worldwide market for travel and expense management software was an estimated $6.9 billion in 2019. It's forecasted to reach $17.6 million. I'm assuming that's supposed to be billion. I hope it's not. I hope it's not going from 6.9 down to 17.6 million. That's a big drop. Yeah, he must mean billion here. Found a little mistake there, but yeah, I mean, obviously, even we can see in all the numbers, these things are all kind of not trading well. In the last earnings call, which was not attended by the CEO, I always think that's a poor move, but maybe there's a reason why. Its primary customer base is being very small, companies up to 100 employees in size. That's the other thing I said. It's important for these guys to try and get into bigger companies, and right now they're still focusing on small companies, which is fine. Maybe you got to scale up, but EXFY card is growing, but it's producing higher cashback costs, pulling down revenues in the process. It's been seeing subscriptions to its existing product grow. The activity-based part of its revenue has been dropping due to macroeconomic headwinds, according to management. So they're facing all kinds of headwinds. What do they spend on research and development? That's one thing I didn't peek at. So R&D here, it's kind of creeping up. Which, I mean, you know, obviously you're trying to get on your feet, so you're going to spend a lot on R&D, especially in the tech sector. You're always going to be spending on research and development because that's the only way you stay ahead of competition because it's constantly evolving. Financial position's reasonably good, so kind of all things that I kind of figured out from the numbers here. I didn't really honestly get much from the article. Yes, this person's saying that the support with it isn't great. I don't know if that's true or not, but you know, as much information. One thing we can do. Sometimes I'll go on just Twitter real quick just to see if I can find anybody saying anything else about it. A lot of times on Twitter, the problem is it's just nonsense. Doesn't look like there's much bullish going on with it. Yeah, I don't think there's too much going on here. He thinks they're going to be the next Google, apparently, according to this. So yeah, I don't have much to add from here. You know, I don't think I have. GTA does have some leverage, but leverage doesn't necessarily scare me. I'll take on leverage as long as I think the free cash flow will benefit in the long run. I'm okay with people leveraging. A lot of times, especially you know with them, they're trying to increase their amount of wells and stuff like that. So when they're doing that, you're gonna have to spend a lot on capex. So as long as in the future they start to pay the debt down, or they're not gonna hit like their maturities or stuff like that. You know, obviously I keep a close eye on it, but leverage doesn't necessarily scare me, Gary. But yeah, so I don't see much else going on with EXFY. This one to me is just one to keep tracking. I'll just keep an eye on it, see what's happening. This is kind of why it's nice to have the daily movers, because if this gets a pop up or down, it kind of gives me an idea on where it's going. I'm gonna take out. I last time I had said I thought it was gonna be a faster grower, but I don't know just yet. I'm honestly I'm gonna put needs more just to kind of follow it. We'll see what comes of it. So last time my evaluation said 291. Now it's down to 233, which means that most likely this will probably continue to trend down. I'll keep the 3 on there for my valuation just because it's a little high, but at the same time it's I wouldn't buy into this unless it got substantially cheaper. I know I put $1.56 there, and I know it's trading at $1.66, but even with that being said, there's not enough here for me to go in on something like this. All right. All right. Well, guys, I'm gonna get going. Just because it's almost 10 here, and I gotta get up tomorrow and continue on with my grind. So Johnny will be on. He'll be on his Thursday stream, and then we'll be doing our Saturday stream. We had changed. I know on the stream we were doing Saturday mornings because Johnny lives in Europe, so the times get kind of off, and we have to find a time that works for both of us. But we were going to push it back, so we'll probably try and we'll put it up on Twitter or something like that. If you guys don't have our Twitter, we'll probably post it on YouTube too somewhere. And that way, you guys, if you want to tune in for the weekend stream where Johnny and I both are doing this, it's a different way having both of us kind of bounce ideas off each other. And you know, not that it's not nice to have you guys in the chat. I appreciate you guys being here. You just make me keep adding things to talk about, and you know, you throw interesting ideas into my head and make me talk about stuff that I probably wouldn't bring up otherwise. But I think we'll probably shoot for on Saturday around 11 or noon. So if you guys want to tune in on that day, we'll go through and continue. We'll probably see what ended up at the end of the week. I'm interested to see tomorrow. See what the Fed says in terms of how they look at interest rates going into the future. Not that I really care too much about the macro. I just find it interesting to follow. So just something to pay attention to. We'll see. Most likely, at most, they'll hint at when a rate cut would be. But core inflation did get below 2% on a 3 and 6 month basis. So we are moving in the right direction with inflation. Still kind of blows my mind to think we might have a soft landing. I still am hesitant to think that. But who knows? We possibly could be there. Yeah, I'm out of beer here too. It's the worst. Mouth's getting dry here talking. But all right, guys. Well, I hope you guys have a good night. Thanks for tuning in, and hopefully we'll see you guys soon. Continue to subscribe and check out the channel, guys. Appreciate you guys all being here. Thanks, guys.